we have to talk about the action in gold. This was Tuesday's live before the breakout. We talked about 1270. We talked about how important this level was, how a move through this level would really generate a renewed bullish underpinning to this market from a long-term technical structure. And we thought that based on our opinion on the dollar, based on our opinion just kind of geopolitically and in terms of the U.S. politics, in terms of the Fed, in terms of pretty much everything going on out there right now, that we said on Tuesday, we can easily envision an explosive medium-term move. It didn't take long for that move to originate. And we think it's just that, the origination of a bigger picture move. Thus, it is rare that we plug our money management business. We really try and keep a Chinese wall between the two. But from this perspective, from time to time, when we really feel passionately in terms of our belief that opportunity is abounding, we'll make this call, and we're doing it now. The last time we did it was in the fall of 2015. We called the low in gold. We called the first part of the big move. We even had the right vehicles in terms of that call. And the market responded. The decline that followed, we were talking about a correction really late July and throughout August. We did two special reports that detailed what we saw as a coming potentially swift and deep correction. And we picked 1250 and then 1200 as the two levels between which you would want to accumulate. In fact, our call for the low was 1198 precisely, and we said buying averaging down from below 1250 would probably be a valuable strategy. Now, of course, that's always predicated upon when you get to that point, is it still a valuable, credible strategy? And at that point, it wasn't. And that's why, it's in terms of some of the special reports that people read, and they're not necessarily customers or they don't get the daily reports. This is why you need to be doing this every day, because it changes so dramatically. And at that point, the election changed everything. From that perspective, the decline was deeper than we thought it would be, but there were many of the vehicles, the GDX and the GDXJ in particular, the junior gold miners, which was one of our favorites, and the silver gold miners, the SIL, did not exceed their downside Fibonacci-defined targets. They were right in line with what we thought would happen. It was gold. It was because of the size of the speculative position was a record high. It was silver because it was a speculative position of unprecedented size. And you had to purge that out of the market. Where you are now is it's purged. If you look at the open interest, you've popped here. There's virtually no open interest. So people are kind of out of this market, and we think they're out of this market at the exact wrong time. Focus has shifted back to what's going on with central banks and now governments and politically and what's happening in Europe. And it just transcends the entire global macro capital markets, economic dynamic completely. The question is, central banks normalizing rates, is it a mistake in the first place? What happens? Credit is largely responsible for this entire feel-good dynamic. You can talk all you want about the improvement in employment. That has it's emboldened people to borrow more. They're not earning more. And you see unprecedented growth in consumer credit, something we've been screaming about for a number of years now, and really since 2014, 33 consecutive months where you are above $200 billion in 12-month growth in consumer credit. That's unprecedented on a massive scale. We have written years ago, in fact, back in really 2013, that the Fed, with QE and the whole nine yards, had already set the stage, sown the seeds for the next potential crisis. It wouldn't be a real estate debt crunch. It would be a consumer debt crunch. The fact that the balance sheet of the Fed was tied right in with the stock market, which was tied right in with consumer credit, which was tied right in to the consumer discretionary ETF. Those things have kept going up, even though the balance sheet hasn't. It's been a function of lower oil prices in 2014, which supported consumer spending, and kind of more recently the stock market and the feel-good factor around Donald Trump. Okay, bottom line, wage inflation is non-existent. Non-existent. It's sporadic. It's selective. It's not broad-based. It's not nearly high enough to support any kind of push in prices received that will expand margins, that will justify stock markets at these levels on profits. On growing profits, rather expectations around the political scene, and all of a sudden, that political scene is called into question, as we said it would be. Our piece at the end of February, California Dreaming, was all over that. You have all kinds of risks now. Sovereign bonds, not the least of them. Okay. Not only that, you got geopolitical risk where potentially Trump is already facing off with Russia and maybe even China. Maybe a little dramatic to say it that way, but it's headed towards that if something doesn't change. Not saying it can't change, not saying everyone can't be friends, not saying this couldn't be a really solid situation going forward. But right now, it's not headed exactly in that direction on a one-way street for sure. From that perspective, the gloves are not likely to come up. But you can't say there's no probability. There's some probability, albeit small. The bottom line right now is the point in gold. The breakout yesterday confirms it technically. From that perspective, it pretty much is some sense of urgency. We have our long-only leveraged precious metals program. It trades in gold. It's a double weighting in gold, and then silver, platinum, palladium. It's a managed account, individually managed, held at the broker in your name. We don't touch the money. There's no lockup. We don't believe in keeping your money with us if you don't want to have it with us. There's a 48-hour turnaround, often quicker, for liquidation and return your capital, and full transparency. You have an open access to detailed report and accounting of positions, profit and loss, and exactly what your account's balance is every single morning. Our program seeks to outperform just holding gold. Bottom line, using leverage, up to 4-to-1, but you're always long gold. You're not long in dollars in a brokerage account. You are long the requisite amount of gold. So from that perspective, you are always long gold, and we look to leverage it when we feel there's price appreciation. And we feel the opportunity in this quarter is going to be significant. Already in the first quarter, X fees, after fees, the program was up 14%. If you want information, email me directly.